Hello guys. So let's say you bought a car, new or used, in 2017 and decided to start driving for Uber in 2020. So now it came time to do your taxes. You looked through some webinars, you looked at the tax software, and you finally came to a section where you need to claim your capital cost allowance for the vehicle. So if let's say in easy situation in year 2020 you bought a car and that was the first year you were driving for Uber, the things would be easy. You would just use the price you paid for the car as the cost of the addition and enter it into the tax software. But because you used your vehicle since 2017 but only started driving for Uber in 2020, where do you get the UCC, which is the undepreciated capital cost, or how do you deal with the capital cost allowance in this year? So I decided to put this video to help you answer those questions. So from the CRA's perspective, what you're doing is bringing a personal asset into your business of rideshare. And to do that, you need to find the undepreciated capital cost of the vehicle at the start of your business. So in this video, I'll try to show you how to do all of that. So CRA has this useful publication T4002 that you can browse through to figure out some things about CCA and UCC. Publication T4002 explains actually how to fill out this form T2125, which you need to file as an Uber driver. So as you fill out your vehicle expenses information in the self-employed income portion of the tax software, the software would ask you for the cost of addition if this is the first year you started driving for Uber. And for you, the cost of addition will be the opening undepreciated capital cost because you're bringing your personal vehicle that you've been already driving before. The cost of addition is an item that you enter into the table for calculation of the capital cost allowance. Now, again, if it was the first year driving for Uber and you bought the vehicle just in that same year, it would be easy. It would be the price you paid for the vehicle. But because you've been using the vehicle before, how are you going to find it out? So we're going to create an accounting fiction and we're going to depreciate your vehicle from year 2017 up to the beginning of year 2020. And we're going to use that undepreciated capital cost as the cost of addition for the year 2020. So let's say you bought a car in 2017 for $22,000 before tax, and it doesn't really matter if it was a new or used car, because the cost before HST and GST is below $30,000. The class of the property for the purposes of CCA is class 10. Because this is the first year, the UCC at the start of the year will be 0, and the cost of addition will be the vehicle price before taxes. Then UCC in column 6 will be the sum of the UCC at the start of the year plus the cost of addition in this year. For a vehicle, the half-year rule applies, which means you can claim CCA only on half of the cost of your additions. So we're going to take the UCC and multiply it by 50% or divide it by 2. The amount on which you can claim CCA in year 1 will be the difference between the UCC and the amount of the half-year adjustment, basically 50% of your UCC. And again, this applies only in first year. The CCA rate for the vehicles is 30%. So now we need to take your base amount for CCA and multiply by the CCA rate. and you will get the amount of the capital cost allowance, which is the same as depreciation, that you can claim as the vehicle expense for year one if you were to operate that asset for business. But we're doing this calculation just to find the undepreciated capital cost of the vehicle at the start of year 2020. So the UCC at the end of the year is then the difference between the starting UCC and the amount of depreciation you claim. So now this amount at the start of the year will be the same as the UCC at the end of the previous year. You are not making any additions in year 2018. We assume it's the same vehicle. So your UCC will be the same as UCC at the start of the year. Half-year adjustment rule does not apply because this is not the first year you're using the vehicle. And the base amount for the CCA we can just copy and paste. If the CCA rate did not change, which you actually need to check, then you take the formula from year for 2017 and copy in year 2018, and the same for the formula for the CCA for the year, which will basically multiply your base amount eligible for CCA by CCA rate and will give you the dollar amount. And the same, we're copying the formula for UCC at the end of the year, which will give us the starting amount of the UCC at the start of year 2019. Now we can copy and paste the whole row of the formulas. So in this cell highlighted yellow, you have what CRA calls opening undepreciated capital cost of the asset. Now you would take this number and in your tax software use it as the cost of additions for year 2020. So from CRA's perspective, this is a new asset that you're bringing into your business, and the cost of addition in year 2020 will be this $9,163.